Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Milling Wheat and London UK Feed Wheat. I'll start with Paris Milling Wheat. It is obvious the market here has moved sideways to lower since early July until mid-August. The problem is that we have had two competing patterns vying for the market's attention during that time. The first pattern was a July to September triangle come wedge pattern, pointing lower, enough to be considered a wedge but not completely out of the triangle class. This pattern had been breached on both sides with false breaks but saw a final break higher in late August. Then there was the second pattern, the late July to early September bear channel. This one looked better at the time, thus we saw the market earlier already reach the primary target for the triangle, and we now have the secondary harder reach target X1 a little above the current market in the 360 area. We also have target X2 for the bull channel in the 346 area. This was reached last week and exceeded. And those exceeded this week. As elsewhere in other grain markets, the declining short medium moving average, currently at 327, had, for a little while in early September, acted as a resisting trend line, but was broken 3 weeks ago. And in the process, this created another pattern, as also elsewhere in the grain markets we've seen. And that's of an ascending wedge pattern. Currently that's 335 to 352. Last week the rising market reached up and tested and was capped by the resistance from the 50% Fibonacci line of the whole of the 2022 move at 348. Now here starts the difficult bit. You see, unlike the other grain markets that I've looked at, the long moving average here in Paris wheat, it's currently at 332, is well below traded levels, well below, and acting as support. This is a currently unique situation. What is not unique is that above we have the medium moving average, currently at 347, arching down to try and reinforce the 50% Fibonacci line at 348, adding to indecision last week as the market was unsure on how to proceed with these two nearby overhead resistances. Well, this week prices broke high over both these two resistances, and its fever to move higher started to tackling the upper trend line of the ascending wedge pattern that's currently at 352. Today is not the first close over this trend line, but it's by far the cleanest close, seemingly cleanest close over it. It's still not that great. It is too early to say for sure, but if this is true, if it is true or a false break higher, there is the feeling of a true break. Mainly, I suspect, because we have so little resistance above, including a gap to be filled between 359.5 and 360.5, and that's until the 50% Fibonacci line, the recent May to August move at 369, and that doesn't look a strong resistance, with better actually between 375 and 390 here. Hence, I might just preempt any attempt higher by placing some possible targets topside for such a breaking pattern. Therefore, a possible target X would be in the 384 area, with a secondary harder to achieve target X1 in the 403 area. It may be early to place these, but we shall see. London UK feed wheat. Some of the action seen here since mid-July had been bearish, if not very clear. By that I mean that we had one of two patterns constructed, either a shallowly bearish channel or a narrow but also shallowly descending broadening wedge pattern over the July to early September period. It depended upon your point of view which you saw. I had prevaricated on which to choose, siding towards the bear channel idea before accepting the descending broadening wedge pattern. Interestingly, what is different here compared to the other grain markets, well, is manifold, and in some respects key to the future, though it does ultimately not detract from the commonality we have seen in the recent patterns elsewhere. For example, the short medium moving average, currently at 269.70, did act here as a proxy for a resistance trend line during August, and was also pierced as we entered September, but then had started to actively act as a support. In that time, it has not only been within the lightly descending broadening wedge pattern, but became actively engaged with the market. Additionally, the long moving average, currently at 272 even, well, it's in the wrong place by quite a distance compared to the other grain markets, rising up into the wedge pattern instead of being above the activity as elsewhere, and while speaking about activity, also becoming actively engaged with the market since mid-July, initially as support and then as resistance, and more recently as support again, guiding prices higher. This leads to another point. In this market, we've not had any dead crosses here. None, no dead crosses, something that has been evident in the other grain markets. So the bearish pressure seen here in July and August has been evident, but in a different form to that seen elsewhere, and without the benefit of the lagging indicator of a dead cross or two. It is therefore, I suppose, no surprise to see the upside tested and then broken 2 weeks ago. However, there was not that much of a free zone above compared to the other grain markets, as prices almost immediately started to test further resistances. These were the neckline from the original head and shoulders top, currently at 280.45, the 50% Fibonacci line, the whole of 2022 so far at 283.70, and the declining medium moving average, currently at 281.30. Interestingly, the attempt higher here is more advanced than elsewhere, as prices broke above all three of these resistances last week, and this week broke clear of them. This now leaves us with the only remaining pattern, a bullish one that is still operational, and that's the mid-August to date bull channel, currently 275.35 to 292.05. Despite the upper bull channel line being breached both last week and this, the bull channel is still intact, and is the current pattern that is directing the market and the bullish incentive. The only factor to bear in mind is that we have here, as elsewhere, a potential V bottom since early July. Now, two final points. Targets for the break higher from the descending broadening wedge pattern are for a primary target which has already been achieved, and the harder to reach secondary target X1, which is still live and in the 294.75 area. Secondly, and finally, if the gapping higher move lasts a week and a strong close last Friday, last week was a weekly key reversal up. An interesting thing to finish off with, and something that may lead to all sorts of interesting possibilities in the future. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.